Hey there, it's Ted Thatcher here, president at Bright Lake Wealth Management. Just wanted to bring you another market update. We finally got through the government shutdown, and so I wanted to bring you some updates about what we have been seeing. Effectively, throughout the government shutdown, of course, the federal government does not publish all the typical economic data points that we are used to keeping our eyes on and analyzing day to day, week to week, month to month. And so now we are waiting actually for that data to still be published. Really interestingly, we just finally got a release from the Bureau of Labor Statistics giving us an update about the unemployment rate. This has been a huge topic of discussion as we had seen the unemployment rate actually slipping the last several months in July and August. The September numbers actually were also gloomy. We have now gone from a 4.2% unemployment rate to a 4.3% unemployment rate in August. The September data that was just finally released after the shutdown shows us now at 4.4% unemployment. Now, why is this important? It's really important because of the Fed's decision making that we are now waiting on. The Fed meets one more time this year, December 9th and 10th, to decide what's going to happen with interest rates. So, coming away from the last Fed meeting in October, Jerome Powell came out and in their official press release, of course, announced that they would lower the federal funds rate by 25 basis points. And he said that the Fed had been more concerned with the labor market and the potential downside risks in the labor market than they were concerned around inflation at this time. However, the Fed members have been fighting amongst themselves about how to split and analyze this data. And of course, that has only been compounded in difficulty because of the lack of data due to the shutdown. So we've been hoping that by the time the Fed meets again, all this new data will be released. The Bureau of Labor Statistics today also released that they would not be publishing the October data that would already typically be at our fingertips. They're instead waiting to release both October and November's data together at the same time. That was originally scheduled for the 5th of December. They rescheduled that release to actually after the Fed's meeting. Now it's going to be on December the 15th. So while we really hoped we were going to get all this data to help inform the last decision the Fed will make this year on interest rates, that now has actually been pushed again after the next Fed meeting. Because of this, the data and expectations around what the Fed is going to do have changed drastically. Before the Fed met in October, the markets predicted essentially a 90% probability that the Fed would be lowering interest rates in December. Now we are literally seeing a 60% probability of no change at all in December, specifically due to the lack of data. When you combine a lack of data with disagreement within the Fed itself, it's really hard for them to make decisions. And when we look at how the Fed has made decisions, especially over the last year and a half, really they have been more than comfortable having a wait and see approach, especially when they don't have the data they anticipate. And so essentially at this point, unless the data changes drastically and we get new insights, we would not anticipate a rate cut come 9th, 10th of December. Now, I don't mean to be all doom and gloom. While we have been flying a little bit more blind than we would typically like to be with the economic data not being released due to the shutdown, we do have a lot of other data points that inform our investment strategy and investment decisions. One actual highlight is the current Atlanta Fed Now GDP estimates. So the Atlanta Fed publishes a consistent estimate of what the GDP, the production, the growth of the United States economy looks like. And right now we are actually sitting above expectations. For Q3, the annualized rate of growth looks to be at about 4.2% actually. Again, much above expectations. Now that number is not a permanent number, it is just an estimate, but if that holds true, that would be a real, actual bright point among a lot of, I'll say, more gloomy economic data that we've anticipated. Something really interesting about that too, as we've seen a lot of the growth in the economy around this discussion of AI, literally 1.1% is expected of that 4.2 number to be attributable specifically to the investments in AI and AI infrastructure specifically. That does lead me to the talking point about what's been going on in the financial markets. You know, we've had this discussion, we've seen in the news headlines hey, are we in an AI bubble? And I think that that is a warranted discussion. We've seen valuations explode at the top of the market with companies like Nvidia. Palantir really notably is trading at a very, very high multiple of their revenue. And so it's created some questions about whether this is sustainable or not. Is the revenue from AI companies actually, warranting the kind of valuations we're seeing? And so fundamentally, when we analyze a topic like this, it has to come down to fundamentals. And of course, revenues are the underlying fundamental we're really trying to keep our eye on. There are companies at the top of this AI boom that have tremendous quality revenue, and there are others, that their true revenue numbers are a little weaker. And so I think that this discussion around an AI bubble is really nuanced, and we want to be specific about which companies we're analyzing and how we are analyzing them. One final trend in Q4 that we are seeing, I believe very much due to this discussion around whether or not we're in an AI bubble or not, is how the global markets, large institutional investors are treating essentially their trading practices as we enter Q4 in the second half of it. It's very common in December for large institutions to sell off some of their holdings, kind of take profits from gains they've had throughout the year. And certainly if they have positions that are at a loss, to lock in the loss for tax loss harvesting purposes as, again, Q4 comes to a close. Typically, we do see that in December, but we're seeing that trend a lot earlier this year, even here before Thanksgiving, which is really surprising to me. And so what it has caused, along with everything with the government shutdown, is a lot of volatility. And so between now and the end of the year, I do anticipate some choppier markets. And really, once that sort of risk on capital comes back into the marketplace, we anticipate that to be typically somewhere in the January, February timeframe, for that to be more likely a time frame in which we will see more stability. Certainly, if we also see data that's hard that the Fed can make real decisions based on. So a lot of different talking points, a lot of analysis here coming at you today, but that is the current state that we are seeing in the financial marketplace. Thanks for tuning in, and I will see you next time.